All right, today on The Explainer, we are digging into a really provocative thesis from investor Michael Saylor. He's making the case that for Bitcoin, there's a critical deadline fast approaching, that a unique window of opportunity is closing. And he argues the clock is seriously ticking. So let's unpack why.
So, this whole argument kicks off with this one very stark, very urgent claim. It's not a suggestion, it's not a maybe, it's a definitive statement. And it's absolutely designed to make you stop and pay attention.
Yeah, so the big question is, too late for what? What does that even mean? Well, according to this argument, it's not about being too late to buy Bitcoin at all, but being too late to position yourself for what's being described as a massive, once-in-a-generation wealth transfer. So in this explainer, we're going to unpack the four key forces that Saylor believes are all coming together at this very moment. Okay, let's get into the first force. And according to this argument, this isn't about guesswork or market sentiment or what people think is going to happen. Nope. This is about something built directly into Bitcoin's unchangeable code.
And this right here, the halving, this is the core mechanic. You can think of it as the scarcity engine. It's this automatic, pre-programmed event that just mathematically, systematically tightens the supply of new coins that can ever enter the market.
And you can see this rhythm playing out like clockwork, right? Every 4 years, it happens. We just had the most recent one in 2024. And the next big one, well, it's already on the calendar, looming in 2028. This predictability is central to the whole argument.
So, to really get a feel for the impact, let's just look at the raw numbers. Before that halving back in April of 2024, there were about 900 new Bitcoin being created every single day.
And then, bam, the halving event happens. And just like that, overnight, that supply of new coins gets sliced clean in half, instantly, permanently.
And this is where that 2028 date really starts to come into focus. Because when that next halving hits, this supply squeeze gets even more intense. That daily flow of new coins gets chopped in half again, all the way down to just 225. So you might be thinking, okay, supply gets cut, so what? Well, the argument points directly to history. There's a clear pattern here. After each of these supply shocks, prices have gone on a major run. Now, of course, the gains have gotten smaller in percentage terms as the market gets bigger. That makes sense. But that fundamental pattern of appreciation after the halving, it's remained remarkably consistent. Okay, so you've got this guaranteed supply shock on one side, but that's only half the story. The thesis argues that this is all converging with a second, equally powerful force, a demand shock. And this isn't coming from everyday retail investors, but from the biggest financial players in the world. And the starting pistol for this, according to the argument, was fired back in January 2024. The approval of these spot Bitcoin ETFs in the US, that was a watershed moment. It was a game changer. It basically made buying Bitcoin for big institutions as easy as buying a share of any stock. Years of friction and regulatory hurdles just vanished. But here's the crucial part of the argument. Even though the floodgates are open, that proverbial wall of money hasn't actually rushed in yet. We're talking about the truly massive pools of capital, the pension funds, the university endowments, the insurance giants. These are conservative, slow-moving entities, and right now, they're still in their due diligence phase. They're doing their homework before they make their big moves. And this timeline is really the core of the whole urgency argument. The idea is that right now, in 2024 and 2025, we're in the setup phase. The pipes are being built, the research is getting done. The thesis predicts that the first real wave of major allocations will start hitting between 2025 and 2027. So by the time we get to 2028, that wave will have already crushed on the shore. The window to get positioned before that capital arrives is, well, now. So we've got the code-based scarcity and the coming institutional demand. The third force in this thesis zooms the camera out even further, from corporations to entire countries. We're talking about a theory of international competition, a whole new kind of strategic race. The thesis points to El Salvador as a real-world test case. Remember all the dire predictions back in 2021? Mockery, warnings of economic disaster, but look at the reported outcomes. The country's holdings turn profitable. The key argument here is that the catastrophe everyone warned about, it never happened. And you can be sure other nations are watching and taking notes. And this all feeds into what's basically a global version of the prisoner's dilemma. Just think about it. One major nation decides to add Bitcoin to its strategic reserves. Suddenly, every other nation faces a tough choice. Do they follow suit and compete for that same digitally scarce supply, driving the price up for everyone? Or do they sit back and risk their own reserves losing value against this new global asset? The argument is that the most rational, self-interested choice for each nation is to start accumulating, which could set off a domino effect.
Okay, so we've got these three massive forces swirling around: program scarcity, institutional money, and nation-state competition. So what on earth does any of this have to do with you or me? Well, this is where the thesis ties it all back to a classic, predictable pattern of how all new technologies get adopted.
It's called the S-curve of adoption. You've seen it play out with the internet, with smartphones, with just about every major technology. Adoption starts out slow with the early pioneers. Then it hits this critical inflection point and just explodes into the mainstream before it eventually plateaus. The argument is simple. The period of fastest growth, the highest appreciation, always happens on that steep, almost vertical part of the curve.
So the billion-dollar question is, where are we on that curve right now? According to this thesis, we are right here, at the very base of that explosive growth phase. With an estimated 5% of the world having any exposure at all, the argument is that the steepest part of the curve, the fastest part of the ride, is what lies directly ahead between now and 2020. And this brings the entire, massive, global argument right down to a personal level. It's not just about market cycles. It's about your own individual timeline. The 4-year question is this: waiting until 2028 means trying to catch up 4 years later, likely at much higher prices and with 4 fewer years for any growth to compound. It's like trying to catch a snowball after it's already halfway down the mountain and moving fast.
So in the end, the thesis doesn't conclude with a price prediction or a guarantee. It just leaves you with this question. It frames the choice as one between acting now, while this potential window is still open, or waiting and maybe spending years to come wondering what could have been. Definitely food for thought.